Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Recently, SEBI data shows that 23% of the actively managed regular schemes have underperformed their respective benchmark by a margin of at least 1.25% in 10 years compared to 10% actively managed direct schemes as on Feb 2023. So why are regular schemes underperforming, and should you then opt for a direct plan vis-a-vis regular plan? Let's understand all of this with Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Adviser India. Kaustubh, good evening and welcome to the show. So what exactly are we talking about? You know, almost 40% actively managed regular plans have outperformed or delivered benchmark returns.
Yep. Hi, Kavita, and thanks for having me on the show. And I think it's a very important discussion. And this is a debate that's been, perhaps being spoken about for the last few years in the Indian market, the whole active versus passive sort of investing outlook. And, they're both sides of the story, right? So let me just break it down. So firstly, the data obviously shows that over a longer time period, significant chunk of actively managed schemes. So if you put direct and regular together, probably about 55% of the schemes are beating the benchmark over a 10-year sort of period. But also what's important to understand is, while the benchmark is a construct, as an investor, when you have to think of a passive option, it would be fair to compare that against an investable peer, right? So we tend to think of the benchmark as a benchmark, for the lack of a better word. But remember, if you have to make an investment into a benchmark, it's typically an index fund or an ETF, and there are obviously costs associated with that too. So if I look at the breakdown of the data that obviously SEBI's put forth, it would probably be worthwhile looking at combination of funds that have outperformed, obviously just the pure benchmark, but also up to about 1.25% of underperformance. Because remember, when I look at even say index funds, and obviously there are not too many index funds with a 10-year track record, but typically on your broader equity indices, you've had some of these funds, you would see that the underperformance versus the benchmark has been anywhere between 0.5% to 1.5%, right? So if I compare an actively managed fund with an index fund, I think the percentage would obviously move up over a 10-year period. But if you look at the more recent history, and we'll talk about the reasons for that, the percentage of funds actually beating the benchmark has come down, which is something which is kind of led to this debate of active versus passive.
So, Kaustubh, what exactly does it mean? Are investors more conscious about what kind of plans they want to go for, which could lead to this also? But then, what does it mean?
Yeah, absolutely. So I think, so when you think about investing, right? So obviously you're looking at, you're looking at, kind of making a return which is to meet your goals, but also to just benchmark yourself against what is the broader market doing, right? That's where the concept of benchmarking is really coming. And if you are getting into an actively managed scheme, you would expect that, the scheme should, through the active management with the professional fund manager, outperform a standard benchmark that it is tracking, right? But remember, there are costs involved. And like I spoke about that, it's first useful to compare that against an index fund rather than purely the benchmark. And B, there are costs associated, right? So like the SEBI study has shown that typically direct plans have, greater percentage of outperformance than regular plans. That's intuitive. Obviously, direct plans are, if I think about equity funds, are cheaper anywhere between 50 basis to maybe almost 1% than the regular plans. There is obviously a cost, of brokerage and all of those costs that are incurred. So all of these leads to a little bit of a drag on the performance. But that said, if I just put into context what's happened over the last few years, right? It's been a little bit of a different market. It's been a polarized market. So if I just jog back in history and see the way some of these marquee benchmarks performed, especially in the period of 2017 to 19, the index heavyweights, right, really added to the large part of the index movement over that period of time. So it was a very, very polarized market. And in fact, some of the index heavyweights, were very close to 10% or are at 10% and excess of that. So obviously, fund managers either had limited exposure or perhaps no exposure in some of these cases because they fundamentally weren't very convinced about some of those stocks, or had an underweight, or couldn't add because of regulatory norms. So all of that did lead to this polarization returns, which which did significantly add, I would say a reasonable amount of underperformance to an actively managed fund versus the benchmark. Obviously, that's, we wouldn't expect this on an ongoing basis. And, things should normalize as we've seen over the longer term track record. And B, very importantly, right, there are, and this is a study that we've done on performance of actively managed funds, and it's an eye opener, and I think all investors should pay heed to it. When we look at the performance of track record over the last 10 years and broke it down into monthly performance, and all we did was look at the funds that had outperformed the benchmark, right, over the last 10 years, and put the best months of performance versus relative to the benchmark on top and in a descending order. And then we looked at how many of those best months of performance actually contributed to the entire outperformance of the fund versus the benchmark, right? On an average, it is 6 months out of 120 months, right? So 5% of the time. And those 6 months can come at any point of time. So you as an investor, if you're not invested in that particular fund during those good 6 months, you would have actually, even if the fund outperformed the benchmark, which obviously we're seeing is getting harder to do, it would have, you as an investor, you would have actually underperformed the benchmark. So I think that's the other behavioral lesson for investors to know and acknowledge, that you can't time your investments. We talk about not timing the markets. You can't even time investments in an actively managed strategy. You need to identify good actively managed strategies and stay invested in them across a market cycle and just be patient, even if they're underperforming in the recent times. And I think that's a very important, sort of lesson that investors should take away from this study.
Hence, we also seeing the consultation paper where SEBI proposes performance-linked TER for active funds also. But then, Kaustubh, let's move on because we have our viewers waiting to ask their portfolio questions to you. But before that, if in case you're watching our show and you want to send us your query, you can WhatsApp it on our number, which is 865-797-4571. You can also email us your query on themoneyShow@etnow.tv. All right, so we move on and okay, so we are going to take Ulas Babu's question from Kuwait, and he's 43 years old and he says he's a moderate investor. Gold tenure is 10 years and he's holding one mutual fund in his portfolio, invested 5 lakh in Parag Parikh Flexi Cap fund, and he wants to add one more Flexi Cap and lump sum investment of 5 lakh in that. So what would be that one more suggestion? And again, the time horizon for that investment will also be 10 years.
Sure. So I think firstly, it's great that Ulas Babu is already making an investment, and he's identified a fantastic strategy to take exposure through a flexi cap fund, which not only gives him exposure through large, mid, and small cap stocks, but also international diversification, as this fund has been buying into international stocks. Obviously, given the caps right now, the allocation has been coming down, but it's still a pretty healthy allocation to international stocks, right? I would think, given his existing holding in the Parag Parikh Flexi Cap, I would recommend that Ulas can look at another Flexi Cap fund like the Kotak Flexi Cap. So again, a very, very well managed strategy, by Harsha Upadhyay. And the beautiful part of, between the two funds, right? We talk about diversification. The similarity of the portfolios is quite limited. So when I say quite limited, it's only about 19-20% of similar kind of holdings within the two portfolios. We've seen that Parag Parikh in the more recent, there's been a little bit of underperformance, and that's completely understandable. Last year was not a great year for obviously, some of the US tech names, while now it's, it's been catching up, but US markets relatively had underperformed at that point of time, right? So when you think about diversification, here's a case where, you can buy into two funds, albeit at the surface, they may look like funds from the same category, have very, very different portfolios, different styles of management. So by adding the Kotak Flexi Cap, which, like I said, is an extremely well managed, very proficient manager, Ulas can get a very well diversified portfolio within his construct of just two portfolio funds, will kind of help him, go a long way in achieving his investment goals.
We don't have him on the phone line, or else we could have asked more questions on his behalf. But then we move on. We have Vikram from Bangalore on phone line with us. Vikram, hi, good evening. How are you?
Hi, good evening, madam. I'm good. How are you?
I'm doing good, thank you. And thank you so much for sending us your query. Let me confirm, you have Navi Nifty 50 Index Fund, you have Kotak Equity Opportunities, Parag Parikh Flexi Cap, Tata Small Cap. All right. And this is how much SIP did you say?
Sorry, can you come again?
You are going to invest for 20 years and you want to step up 10% also.
Yes. Every year, 10% step up, and it's for 20 years.
All right. What's the corpus that you're looking at?
2 CR.
All right. Kaustubh, around 29,000-30,000 investment right now. Also, I wanted to ask one question on Navi Nifty 50 index. You have a lot of other AMCs offering you same category fund. Why would you go for a smaller AMC for this particular category? Kaustubh?
Yeah.
Along with that lower expense ratio.
Right.
Because of these 2 reasons.
Right. I mean, what's the expert view on that, Kaustubh?
Yeah, sure. So let me, maybe address the portfolio question first before I get a very specific question on the index fund, right? So, if I look at the overall construct, and I think what Vikram has very nicely outlined is, he's got a good 20-year runway to building his corpus, and very rightly he intends to step up the SIPs by 10%. I would encourage him, at least 10, if not more, as sort of the financial situation permits. But when I think about the construct of his portfolio, I think broadly good, and I'll address the Navi question in a minute. But given that he has a 20-year horizon, I think there is a propensity that you can take on a little more small and mid-cap exposure. If I look at the existing breakdown of the investments, almost about 75% currently is kind of allocated towards large caps, given that the Nifty 50 index fund is a significant part of the SIP of the portfolio, right? And then you have a little bit in a large and mid cap fund and a flexi cap fund and a small cap, right? We can maybe increase the mid cap exposure a little bit, and you could probably just add to one of the existing large and mid cap or flexi cap funds, which will in a way kind of increase your mid cap exposure. So take away some of your SIP amounts, maybe about 3,000 rupees at the current values from the index fund, and move it to a Kotak Equity Opportunities or the Parag Parikh Flexi Cap, which will just kind of move you towards a little more aggressive positioning, so to speak. But given that there's a long time horizon, I don't see that as an issue in the portfolio. That's definitely one of the recommendations that I would make. Now, specifically about obviously this index fund versus the others. So to be honest, we are very, very agnostic, between the size of the fund or the fund house, because this is clearly obviously a passively managed strategy. So so the things that an investor needs to check for, and I think one of the things obviously Vikram very clearly outlined, is expense ratio. Obviously that's important because the cheaper it is, the lesser it's going to eat into sort of the tracking difference. I think the other thing that's also important to keep in mind and evaluate, and we'll as this fund seasons we'll get a better idea, is how good is how low is the tracking error and the tracking difference of this strategy, and in terms of how well is it able to execute and replicate the index on an ongoing basis. And there are several other index funds which might be a little more expensive but have extremely low tracking errors attributed to them, and with long track records. So I mean that's just I'm just playing the devil's advocate that you might be getting 20-30 basis points cheaper in expenses, but it's also important to look at tracking errors. This fund is obviously still building a longer term track record, so that's the only one thing that I would keep an eye on. But otherwise, I don't see an issue as long as they continue to do a good job in terms of managing it very close to the index, right? So I think that's broadly the construct that I would recommend Vikram to do in terms of just that tweak to the portfolio. We already spoke about stepping up his SIP needs, at least by 10%. And about the goal that he spoke about, and just doing very quick back of the envelope math, that he's currently doing about 29,000 rupees SIPs per month,
right?
And obviously step it up. I think he'll comfortably reach his goal of 2 crores. In fact, he'll far exceed that over a 20-year period. Yeah.
Quickly, we move on to our next viewer, Rahul Yadav from Indore. Hi, Rahul. Good evening.
Good evening, ma'am.
Okay, so you have Parag Parikh Flexi Cap, Murasset Mid Cap, Axis Small Cap in your portfolio, and you have 1 lakh investment lump sum in Canara Robeco Small Cap and PGI Mid Cap. Why specifically only Mid Cap and Small Cap in your portfolio and then 1 Flexi Cap?
Yes, ma'am.
Rahul?
Yes, ma'am. Yes, ma'am. I want to review my portfolio. Is this good or should I change my portfolio?
You will be invested for how long, and what is the total amount of SIP?
Ma'am, I'm investing in these funds from for 2 years, and I'm looking for 30 years more.
All right. Kaustubh?
Yeah. So firstly, I mean, Rahul, great that you have a 30-year horizon. It's a very rare thing to hear. So very pleased to that you're acknowledging that you need to be invested in the markets really to make sort of long-term returns, especially in equities. My only advice to you, and when I look at the construct of your portfolio, and like Kavita pointed out, I ask you that there's a significant tilt towards mid and small caps in your portfolio. Obviously, you have one flexi cap, which has a large cap bias. But when I just look at the underlying construct of the 3 SIPs that you're running right now, it's almost a 33 sort of portfolio with only 33% in large caps, and the remaining 2/3 of the portfolio, which is towards mid and small cap stocks, from the funds that you hold, right? Now, my advice, while obviously mid and small caps are great long-term sort of, but any portfolio construct should still, to prevent too much excess volatility, because we've seen periods where mid and small caps have gone through significant drawdowns and have stayed depressed for a long period of time. And that's why we recommend that ideally the core holding of your portfolio, irrespective of how long your investment horizon, should always comprise of, kind of the bedrock, the large cap sort of stocks. And that's why I would recommend that take this up to at least, about 60% in large caps, and 40% is actually a very healthy number in terms of mid and small cap exposure in your portfolio, which will then kind of help you, and 30 years, like I said, is going to add a lot of compounding to your portfolio. The other thing, like we were telling the other viewer, step up your SIPs, right? So today you're doing about, I think about 3,000 each in 3 funds. Try to aggressively step that up, 10, 15, 20%, as much as your financial situation permits. Do that year on year, because the earlier you start with larger sort of sums of money, and that's how it can grow over that long period of time. Obviously, time's your friend here. And like I said, when you're rejigging the portfolio, maybe reduce a little bit of the mid and small cap exposure, add to either a large cap index fund, or there are a couple of good actively managed funds from the large cap space, like the Mira Large Cap, the Birla Frontline. You can pick one of these to make the exposure more rounded rather than being very, very staggered towards mid and small caps.
All right, I think that will be all. Thank you so much, Rahul, for sending us your query. And with that, it's a wrap. Thank you so much, Kaustubh, for being on the show, helping our viewers with their financial portfolio today. And